Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Alright, hello and welcome to Camel Finance. I'm your boy Camel and it is finally Friday. It's been quite an interesting week, I'd say quite entertaining as well. I just basically want to point at a few things and encourage people to continue to think for themselves, continue to fact check and verify what people online are saying, including me, okay? And then I'm going to point at a few Bitcoin charts as always and look at a few live positions in TA because as we are wrapping up the end of FOMC week, the markets are actually remarkably strong, I think. So we'll point at that as we head into the weekend and the weekly closes. And of course, tomorrow is Saturday, so we'll be back here with a weekend's deep dive video, reassessing the base case hypothesis of the channel. And if you're a level 3 member, there'll be a members video for you guys as well. So yesterday in the live stream, by the way, if you haven't seen it, you can go back and watch that on replay. But yesterday in the live stream, we were talking about how this was circulating, okay? Not a single period that was negative for equities 12-month out when the Fed has started to cut rates at or near all-time highs. And so a lot of people were saying, hey, Camel, you're talking about these rate cuts potentially being bearish, but this doesn't seem to be the case, right? What about this? And so I pointed at this community note and said, look, this thing got community noted, right? This is completely wrong. In September 2007, the Fed cuts rates with the S&P at all-time high. 12 months later, we were down 24.3%. And in June 2019, they cut rates again. 12 months later, the S&P return was down 7.4%. But the funny thing about this is a couple of you eagle-eyed viewers out there did the correct thing. You fact-checked what I was saying as well, because this community note is actually wrong. It wasn't June in 2019 that they cut the rates. It was actually August of 2019 when they started to cut the rates. But it goes to show, doesn't it? Like, there is this real problem with the internet now. It's like the dead internet theory, when you really can't tell what is real and what isn't anymore. So I guess my message continues to be the same, and that is that we should all be doing our due diligence. We should all be doing our best to fact check and verify absolutely everything we see. And just remember, there's going to continue to be more and more bad takes online because we are approaching a top, and it's at the inflection points, okay? As we approach the end of these 4-year cycles, as we start to actually head for some real macro tops, this is where the majority of people become wrong-footed, right? Remember, the herd is often correct for a while in the middle. It's at the major inflection points that it pays to be contrarian and bet against the herd. But if you think about this, you know, we have a trend at the bottom. Nobody wants to be a bull here. Then we get a big rip-roaring bull market, and every man and his dog in here becomes bullish and one-sided correctly, because again, it doesn't take a genius to look at this kind of chart here and say, well, okay, now it's an uptrend, now it's time to be bullish, now it's time to say we're going to go higher, okay? But remember, it's at the major inflection points when again it pays to be contrarian and everyone will be wrong-footed and wrong-sided. So I believe we're still in that kind of middle period where everyone is right for a little while longer, and then it's soon going to be time to be pointing at the herd, being one-sided and say, I want to be on the other side of that herd. So expect more and more bad takes. And here's one I saw yesterday that again just triggered me for no apparent reason, right? But apparently the bond market has completely rejected the first rate cut. You've probably seen tweets like this because there was dozens and dozens of them circulating the internet yesterday, right? Apparently yields have ripped higher following an initial drop on the rate cut announcement, and the rate cuts had the exact opposite effect of what the Fed wanted, allegedly, right? Mortgage rates will now spike. And I was saying, like, how on earth do people come to these types of conclusions, right? There is nothing more going on in the 10-year yield than a counter-trend bounce at the moment, okay? And even if it comes all the way back up here and then rolls over, does it really make a difference? No. The overall trend is still down, and until such time as we make a repair out of this downward sloping red resistance line, until such time as we get an actual breakout above there, then all kind of bullish talk is nonsense. It's literally wrong, okay? It's not up for debate. It's not, you know, TA is subjective. There are times when it is malpractice to be bullish. And when we have a chart like this, it is malpractice to be bullish until such time as we get a true breakout of this downward sloping red resistance line. Now, to illustrate my point further, okay, the US 10-year Treasury, granted this is the bond, but if I use the 10-year Treasury, here you go, you can see it's the exact same chart, right? Draw our lines on in here. In fact, it's even weaker when we use the 10-year Treasury instead of the 10-year bond yield. But this is a barometer of the economy, okay? This is why I often refer to this chart as the chart of truth. When yields rise, it's a sign of positive investor sentiment for a strong economy. However, when yields fall, buyers are seeking safety and security in an uncertain environment. Now, here is the most important part. How does the US 10-year Treasury affect mortgage rates? Because there typically tends to be a very hard-coded relationship between the two, right? Where the 10-year yield goes, where the chart of truth goes, so does mortgage rates. It just tends to be that there is a 2-point spread. It even says this somewhere. Historically, the spread between the two has been between 1 to 2 percentage points, okay? But this is exactly the point. When these yields are moving down like this, when we are continuing to beat this same drum and say tell that to the bond market, guess what's going to happen to mortgage rates? You guessed it, okay? They're going to continue to fall. If we overlay the United States 30-year mortgage rate on top of this chart, again, you can see where one goes, so does the other, right? They practically track one to one, just in slightly different orders of magnitude. I bet if I change the scale on here, you'll be able to see the correlation is even clearer, right? These things move one to one. There's a reason I call this thing the chart of truth, and there's a reason I constantly say tell that to the bond market. So I don't know where we get these bad takes, as ever, okay? Continue to fact check me as well as everyone else. But also, I am a big preacher of keeping it super simple, okay? If this 10-year yield or the 10-year treasury yield is moving lower, okay, then so are all rates, okay? And it's really as simple as that. The idea that the market or the bond market is rejecting the Fed rate cut, again, is absolutely nonsense. We are currently almost 92% in favor of seeing another 25 basis point cut at October's meeting, okay? So the market is absolutely not rejecting the Fed cuts. In fact, what the market is doing now is repricing rates in favor of yet another 25 basis point cut. Remember, we spent the entire month leading up to FOMC just gone saying it doesn't matter what anyone thinks, says or does, doesn't matter what anyone's speculation or opinion is, because we tell that to the bond market. And by that, we really mean we look here at the bond market futures and figure out which way the rate cuts are going to go. Now, right now, they are above the 85% threshold to say that we've got as much certainty as is physically possible in a market that this is what's going on. And so again, we can continue to tell that to the bond market. All these opinions are kind of silly. You just need to look here and say, is this above 85%? If it is, then we can say for damn sure that there will indeed be another 25 basis point cut. Now, of course, this is subject to change, okay? It's a market, anything can happen, and it can reprice accordingly. But right now, it hasn't done anything like that. So the good news here is, okay, if you want to outperform practically everyone in the market, all you need to do is tell that to the bond market. One final bond market trick for y'all is this right here, okay? Anywhere the 2-year yield goes, the Fed funds rate will follow. So if you want to predict what's going to happen to the Fed funds rate, you simply look at which direction the 2-year yield is moving. And again, you can outperform absolutely everyone with their opinions and their speculations and everything else by simply saying, which way is this green one going? If it's going down, then that's where the Fed funds rate is going as well. Same deal with this. So what about short-term charts? What about direction for the next few weeks or months even? Well, as Andrew points out here, we've got a 4-year cycle low to deal with in 2026. But this in general makes sense, okay? Once the S&P broke the Great Depression high, it was 76 quarters until the 73 top. And when that top was broken in 1980, the bull run ran for 78 quarters until the tech bubble burst, which means the current secular bull market is middle-aged and could extend well into 2029 or 2033. However, if we really are indeed in that blow off top, if we really are about to make a good couple of years worth of gains inside of a short period of time, then it's entirely possible that that whole stagflationary lost decade idea is going to come to fruition a little earlier. Whilst it is still my call that that's the case, I am very much open to this and would welcome this. I would absolutely welcome this. It would be way easier for us to make money if this is what's coming, okay? A continuation of this trend angle right here until about 2033, right? That would be so easy to deal with relative to what I am calling for. So I would love to be wrong about this, but what tends to happen, okay, is if the trend stays this way, okay, then it can continue and we can say it's pretty much healthy and it's on pace. But if we do start to go more and more vertical here, then what we are actually doing is forward pricing the gains to come, okay? And so the more vertical we go, the more likely it is we have to correct back to the mean. So if you're a champion of a long-term bull market, what you really don't want to see is a huge spectacular blow off top into the end of this year. Because if we go completely vertical into the end of this year, then it's likely that we would have put all those gains on the table ahead of time. And that's sort of what we've seen in MicroStrategy, right? You know, MicroStrategy put in all of these gains well ahead of time, and it topped all the way back in November of 24. It was almost a year ago that it hasn't made new highs. It hasn't even really come anywhere close to its prior high from November of last year. So it's been a while, right? But this is what happens when the market overheats and goes completely vertical. When you put in something like a 40x move off the lows in realistically what was about 24 months, then we do have to spend more time digesting that move. And so if something like this is coming for the stock market, if we're about to moon past this kind of 7 to 8K level for the S&P, then in something like 3 years for the S&P 500, we would have put in 129% returns, right? I mean, that's a lot of returns we would have squeezed inside of 3 years. You would not ordinarily get 130% for around, I don't know, 7 to 12 years on average for the S&P, right? Normally it would take somewhere in that kind of neighborhood. It would take approximately a decade to get this. And if we've squeezed it into 3 years, kind of tells me that similarly to that MicroStrategy idea, we would have forward priced the gains and then have to spend more time digesting it. So as ever, we'll stick with it, right? We'll stick with it until invalidated, and we'll hope that we're wrong so that we can have a much easier market to deal with. But the market will need to prove that to me before I can accept it. Over in the world of Bitcoin, I've got a couple of things to show you, and then we'll check out for the weekend. The weekly stochastic RSI has crossed up, confirming a strong bullish signal, and every time this signal came in the past, Bitcoin was oversold and then pumped up. So you can see every time at the bottom it crosses, we get big moves for Bitcoin, and it's probably going to be the same deal here, I should think. Meanwhile, Bob is pointing out that there's many alts pushing nice uptrends, and Bitcoin is just a couple of solid candles away from all-time highs, while the sentiment sits at neutral, which is a good place to be at this 4-year cycle, and this is the key time to sit back and let the market do the work. But he does point out his only concern, short term, is that stocks are really stretched on the cycle uptrend, and very few cycles historically have gone this far without a mini 4 to 6 week reset. The interesting thing here, though, is he says you could argue Bitcoin has already done its 4 to 6 week reset, and the two don't have to be that correlated. So what does that look like? Well, the stock market from the prior weekly cycle low looks pretty stretched, okay? It looks like it is due a nice quick flush, hence this yellow squiggle being the path of the most probabilistic outcome. It does look like we need a good flush here to reset this weekly cycle, and that was Bob's original count here, remember? He was counting from this here as a new cycle and then looking for a flush into early October, which would also sync up with the stock market, and we've been talking about hopefully getting a weekly cycle behind us. But if we can't roll over practically right here, right now, especially given today is day 47, then we have to continue to accept this count here is correct. And that means the yellow squiggle is in play. That means we're probably going to work our way up to the next daily cycle, then invert into a weekly cycle. And then if we're really lucky, we've got another push. So I'm still cheering on one final lower low. I would rather that just to tuck that weekly cycle behind us and see the further upside. But overall, we're in position either way, right? So we can't really lose. If the thing's going to rip, we'll just let it. And if there is one final lower low, then we know we can back that trade into the end of the year and then start to target sells for the end of the 4-year cycle. I expect that to be highly contrary, and I think most people are not going to want to sell there with me, but frankly, that's what I'm hoping for. I don't really want everyone to be on the same side as me as I'm offloading my positions. And the last thing to point out is gold, which continues so far at least to continue to head up, as is silver again, and I'm still pushing some of these minor trades. I know some of the members have started taking profit. There's nothing wrong with that at all, by the way. Okay, these have been spectacular returns, but I am a push my luck kind of trader. To each their own, right? There's nothing wrong with nailing down the gains here. I know a lot of people are extremely happy with the gains they've made, and that's absolutely fine. Don't ever let anyone tell you not to lock in a level if it's uncomfortable for you. We all have different risk profiles and risk tolerances. My risk profile is reasonably high here, right? So I'm okay with pushing this. And like I said to the members, I don't mind if this thing gives back a bit and then I cut out here because we miss a bit at the bottom, miss a bit at the top and catch the meat in the middle. That's fine with me. But a lot of people have not really seen gains like this for a while, right? A lot of these members are looking at this and going, oh, I need to lock this down. And that's absolutely fine, right? If you don't want to gamble on higher prices here, then take the profit, walk away and laugh all the way to the bank. But for me, I'm going to keep pushing for a few more days at least, I think. And again, as always, okay, my message is pretty simple. Keep an eye on the 10-year yield, okay? Keep an eye on physical repairs. If we don't get any repairs made, okay, then there is no case to be bullish. It is literally malpractice to be bullish yields here. So expect some kind of move up and then a rollover, and we'll continue to tell that to the bond market. I'm your boy Camel. Have a fantastic weekend. See you tomorrow for the weekend's deep dive. And until then, all the best from me. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel